Imagine, just for a second, a machine. And not just any machine, but a flawless, incredibly elegant, money-printing engine. And this wasn't built by just anybody. It was constructed by the absolute smartest men on planet Earth. We are talking about legendary Wall Street titans and literal Nobel Prize-winning mathematical geniuses. They built a financial algorithm that was so sophisticated, so entirely insulated from everyday market risk, that they actually thought they had achieved the impossible: risk-free money. I mean, it was the ultimate sure thing. But, in their quest to build this mathematical holy grail, these undisputed masters of the universe forgot just one simple, unquantifiable variable. And that single oversight, well, it set the stage for something completely unimaginable.
So how do you build a machine that actually outsmarts the stock market? Okay, let's dive into this. The story we're unraveling today is honestly one of the most astonishing mysteries in modern financial history. We're going to look at the completely clueless background story of how these absolute titans of finance created a system they believed was utterly bulletproof. I mean, these were the smartest guys in the room. They created this unstoppable juggernaut and were completely convinced they had conquered financial gravity itself. So how on earth did a room full of the brightest minds on the planet build a supposedly perfect system while being completely blind to the fatal flaw hidden right there in their own brilliant design? To figure that out, we have to go back to the beginning, the rise of this ultimate money machine. Back in 1993, there was this legendary Wall Street arbitrage guy named John Meriwether. And he decided he didn't just want to run a good hedge fund. No, he wanted to build the greatest financial team ever assembled in human history. So he founded Long-Term Capital Management, or LTCM, out in Greenwich, Connecticut. His entire goal was to create a firm that operated on a totally different intellectual plane than anyone else on Wall Street.
And Meriwether, well, he got exactly what he wanted. He brought in the absolute heavyweights. Most notably, he recruited two incredibly brilliant mathematical economists, Robert C. Merton and Myron Scholes. Now, these two weren't just smart, they had literally written the mathematical formulas that Wall Street used to price risk. In fact, by 1997, they would jointly win the Nobel Prize for their work. Having them on the board gave LTCM this undeniable aura of invincibility. The arrogance was palpable, and honestly, the market thought it was totally justified. Investors were practically begging to give them money. They figured, hey, these guys literally invented the formula for modern finance. It is mathematically impossible for them to lose.
Now, what's really interesting about this slide is just how staggering their initial winning streak was. Look at this, 20% returns in 1994, an unbelievable 43% in 1995, 41% in 1996. They were absolutely crushing it. Their whole design was what's called market neutral. Basically, they used their wildly sophisticated math models to exploit tiny temporary price differences between similar types of securities. They'd bet that these price spreads would eventually converge. Because it was market neutral, their models expected to print money regardless of whether the overall stock market was booming or crashing. It was a total masterpiece of financial engineering. It was essentially like picking up nickels in front of a steamroller. Completely safe, right? As long as the steamroller doesn't suddenly speed up. But here is where things start to get tense. Beneath those massive, envy-inducing returns, a fatal flaw was quietly ticking away. You see, the very nature of LTCM's strategy, picking up those tiny fractions of a percent on these little price convergences, meant that they actually earned a very, very low return on every individual dollar they invested. So, to turn those tiny little margins into 40% annual returns for their investors, they couldn't just play small. They needed to scale up massively, and to do that, they required a hidden bomb.
And that bomb? That was leverage. Now, leverage is simply borrowing considerable money to multiply the potential return of an investment. But in LTCM's hands, leverage was basically financial nitroglycerin. Because they were only making literal pennies on each individual trade, they had to borrow billions with a B to turn those pennies into massive, market-beating profits. Now, leverage is an incredibly effective financial tool when things go right, but it is highly, highly dangerous. It gets the job done incredibly fast, but if you make even a tiny miscalculation, the blowback is absolutely lethal.
So the crucial point is that by the end of 1997, a terrifying ratio had formed. For every single dollar of their own capital, they were holding about $30 in debt. 30 to 1. Think about that. They commanded over $100 billion in assets, entirely built on a foundation of massive borrowing. They were using this extreme leverage to seek profits across a huge range of markets. We're talking government bonds, mortgages, equities, and thousands of complex derivatives. The level of risk they were taking was practically insane. But of course, their brilliant models told them they were perfectly safe.
Then came the global panic. In 1998, the financial landscape started to tremble. The crisis that had started in Southeast Asia the previous year, It suddenly intensified and began rapidly spreading across the globe. And then, without warning, it hit Russia. This was the ultimate black swan event. It was an unpredictable, extreme outlier that the Nobel laureates' flawless, historically based models had simply never accounted for.
On August 17, 1998, the unthinkable actually happened. The Russian government shockingly devalued the ruble and defaulted on its domestic debt. A sovereign nation defaulting on its own currency. It was completely unprecedented. Total, unadulterated panic gripped the globe almost instantly. Terrified investors worldwide desperately sought safer, liquid investments. They dumped absolutely everything risky and fled straight to the absolute safety of U.S. Treasury bonds.
And this is exactly when the mathematical genius of LTCM completely broke down. Remember how they made their money? They bet that the price spreads between different types of bonds and securities would eventually converge. But here's the thing. Mathematical models assume markets are rational. Panicked humans are entirely irrational. In the sheer blind panic following that Russian default, investors didn't behave according to some neat little bell curve. They acted out of pure primal fear. Because absolutely everyone rushed to safety at the exact same time, the spreads didn't converge. In almost every single case across LTCM's massive portfolio, the spreads diverged. Everything went in the exact opposite direction of their bets, all at once. Their infallible models weren't just wrong, they were fundamentally broken.
The pacing of this collapse is literally like a financial thriller. Let's just look at the ticking clock here. On August 17th, Russia defaults. Just 4 days later, on August 21st, LTCM loses $553 million, and that was in a single day. By September 2nd, the fund is forced to send a letter to its investors disclosing massive, horrifying losses. That made their vulnerability totally public to all the ruthless predators on Wall Street. The blood was officially in the water. By September 18th, realizing they are utterly trapped with nowhere to go, LTCM officials finally pick up the phone and contact William McDonough, the president of the Federal Reserve Bank of New York.
In the month of August alone, an astounding 44% of LTCM's value was completely wiped off the map. This wasn't just a bad month, guys. This was a total death spiral. Because of that insane 30-to-1 leverage we talked about, their capital was evaporating so fast that they were facing total insolvency. But remember, LTCM wasn't operating in a vacuum. They had thousands of complex derivative contracts tied up with literally every major bank on Wall Street. If LTCM collapsed, all those counterparties would try to seize and sell LTCM's assets at the exact same time. It would trigger a catastrophic global fire sale.
Which brings us to a desperately needed rescue. When the team from the New York Fed actually visited LTCM on September 20th and peeked at their books, they were terrified. The true, dangerous scale and scope of LTCM's positions became shockingly apparent. The Federal Reserve realized that if LTCM went bankrupt, the resulting fire sale of assets into a market that was already absolutely panicking would cause a massive chain reaction. It would trigger huge losses at major banks, completely dry up global credit, and could potentially impair the entire global economy.
So, the tension reached its absolute peak on September 23, 1998. New York Fed President William McDonough essentially took the heads of 14 of the biggest, most cutthroat Wall Street competitors. We're talking firms like Goldman Sachs, JP Morgan, Merrill Lynch, and he locked them in a room. Now, there was a brief moment of hope when legendary investor Warren Buffett actually led an independent offer of roughly $4 billion to buy out the partners. But by the 12:30 p.m. deadline, legal issues completely killed the Buffett deal. So sweating bullets with no other option, these 14 competitors faced a really bitter irony. These men, who absolutely hated each other, were suddenly forced to pool their own money to save the arrogant geniuses who had been beating them at their own game for 5 years. By 6 p.m., after hours of bickering, they finally agreed to inject $3.625 billion just to keep LTCM afloat.
Now, the Federal Reserve brokered the deal. And this brilliantly illustrates a crucial distinction. The Fed didn't use a single dime of public taxpayer money. Instead, they essentially forced the creditors, the very banks who had the absolute most to lose if LTCM went bankrupt, to finance the rescue themselves. It was a very clever maneuver. It stopped the immediate panic of a fire sale while simultaneously trying to avoid the long-term moral hazard of having the government step in and bail out reckless private gambles.
So the global economy was pulled back from the brink. But what about the aftermath? Well, in exchange for that $3.6 billion lifeline, the consortium of banks seized 90% ownership of LTCM. Think about how crazy that is. The brilliant founders, the guys who just a few years earlier had been the untouchable kings of Wall Street, completely lost control of their own creation.
And the dismantling of LTCM was incredibly swift and honestly deeply humiliating. The partners were completely stripped of their lucrative bonuses and placed on limited, fixed salaries. They had a strict oversight committee made up of consortium representatives basically breathing down their necks every single day. The emotional contrast must have been absolutely brutal. I mean, these were Nobel laureates, men who once dictated terms to all of Wall Street, and now they were chained to their desks on an allowance, acting as salaried employees, whose only job was to slowly clean up their own colossal mess and unwind their life's work. By early 2000, the fund was permanently closed.
When the dust finally settled, the final total loss suffered by LTCM and its investors was a staggering $4.6 billion. It's a sheer cliff drop. The irony is just breathtaking when you think about it. The ultimate, perfectly engineered, supposedly risk-free machine ended up generating one of the most reckless, catastrophic losses in financial history. The machine broke, and it took billions of dollars just to clean up the wreckage.
The whole LTCM crisis revealed the extreme danger of highly leveraged institutions operating in the shadows. And honestly, it forces us to ask a really provocative question. If the absolute smartest minds on Earth, literal Nobel Prize winners with unparalleled resources, can be utterly blinded by their own mathematical hubris, creating these illusions of safety that almost destroy the global market, does the financial system ever truly learn its lesson? Or are we always just one incredibly complex, deeply flawed model away from the next catastrophic fire sale? Something to think about.